What do you think the Fed will do? What do you think the Fed should do?
The Fed's going to do 25 because, as Steve said, it's priced into markets. The problem with doing 25, when you've already hinted that you'll do 50 for the year, is that market participants are going to see a succession of 25 basis point cuts and extrapolate. They're just going to draw a straight line, and the Fed's going to be in a position where they're expected to ease too much. I think what they should do, 50 basis points, say this balances the risk, dig a fire break, and then just wait for the data. What they really should have done is not tighten in December, or at least not pivot so strongly, but that's water under the bridge.
Hey, and let me just follow up on one other issue, which is you heard what Steve said about the rest of the year. So forget about just today. We got 2 more in the offing. Does that make sense to you?
Not particularly right now, given the economic data. We had heard that the decline in inflation was supposed to be transitory. Employment gains are still well above the run rate that keeps the unemployment rate unchanged, and we see wage growth picking up slowly. They're going to be easing policy because it's built into financial markets, and they don't want to tighten financial conditions too much. But if the president actually delivers something on trade, it doesn't have to be much. We're going to see a different configuration of markets, and they may look back at this with regret.
All right. Hey, Brian, why do you and your colleagues seem to think that this is going to happen 3 times already this year? I mean, I'm with Vince. It doesn't make sense to me.
No, I mean, we only look for 2 rate cuts this year, and it doesn't make a lot of sense to me either. I can't understand what changed so dramatically in the data from 10 months ago when we were far away from neutral, and now they feel the need to cut rates. I mean, inflation doesn't look that different. So I think the Fed needs to better articulate their story and what they're really watching going forward.
Hey, Steve, jump in.
Yeah, I was going to say, I was looking this up yesterday. To Brian's point, I think that the outlook for GDP is like 0.2% lower today than it was. This is for using the Fed's own forecast, than it was in December. In the unemployment rate, about the same. Inflation, just a little bit lower. You don't have the kind of change in the forecast, or as Vince suggested, change in the data to warrant this really double pivot. It was a pivot from hiking to hold, and then from hold to cutting. And I just wonder if I could ask Vince how he thinks the chairman gets up and explains this, because maybe, Vince, there's another pivot here from data dependent to something else.
So I think the big change was from December to January. The Fed earlier had been leading markets. Jay Powell was in front of the pack saying, this is what we're going to be doing. We're on autopilot on the balance sheet. We're going to be doing these rate hikes, and got criticized a lot. He got criticized in markets. He got criticized by the president. Now they're pushing the data dependence. He's gone to the back of the pack. But the problem is the pack, financial market pricing, has gotten way ahead of him. I think the risk is he does 25. There's some weight on 50 in markets today. And it'll sound a little dovish, and then people will just extrapolate.
But Vince, I want to push back. Vince, I want to push back a little bit. If I raise my hand at the press conference and I say, Mr. Chairman, what data are you looking at? Which part of the forecast has changed to warrant this dramatic change in policy? How would you think he would answer that question?
We are in a big world. We see a marked slowing in global trade and global industrial production. There are considerable risks out there, and we view this as insurance to protect ourselves from those risks.
But to Steve's other point, are we still a data-dependent Fed?
Not particularly. We're following markets.
Yeah. And does that worry you, Vince?
Oh, sure. Again, my chief worry is that he does 25. He sounds dovish to justify the disappointment for not doing more, and it just bakes in the cake 75 to 100, and we'll get to the September meeting in the same position. Do you want to disappoint markets and tighten financial conditions? At some point, they're going to have to. At some point, if the data roll the way Steve's talking about, they're going to have to actually be the grown-up in the room and say, we don't need this much easing.
Okay. Hey, real quick, Brian, what do you think the market's reaction is going to be if it's anything but? Well, I don't know. It's not going to be anything but. It's going to be what it is, probably. But what does the market do?
I think you have a little bit of short-term disappointment that the Fed's not a little bit more forceful, but you know, there's not a lot of other alternatives out there right now. So lower rates continues the kind of wins in the markets, sales, so to speak, as long as there's not some unexpected shock out there that occurs.